Hey, good morning, everybody. It is Tuesday, May 12th, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products such as Originator Success to help you get found online, be found, be chosen, be remembered. Grab and Go Social, providing you with content daily that you can just grab and go post, as well as coaching and community to help you build your online social presence, and Rate Sensei, all the good stuff going on about rates and pricing. So go check those out. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time, broadcasting to you on Facebook and on YouTube. Got an interesting mix for you this morning. Cashews and coffee. I don't know. I just had some. It's good. Better than I thought. I guess it makes sense. My wife drinks flavored coffee, but I never saw cashew flavored coffee. It's always like caramel and I don't know, coconut and all kinds of weird stuff. So anyway, today we'll be talking about what's going on in Iran, the current outlook, effect it's having on rates. Of course, we talk about that every day because that's the biggest driver. We've also got the CPI inflation data today, and we'll talk about what we got going on through the rest of the week. Remember, you can join me live each and every weekday morning. The easiest way to do that is get a text reminder so you don't have to worry about missing a moment of the show. If you don't get our text reminder, go ahead and sign up at hmmr.io/reminder or use this cool QR code over here and get signed up to get that alert. Also, each morning we send out our daily email, and you can sign up for that at www.ratelockadvice.com. Feel free to use it any way you want. You could put it into ChatGPT or Claude like Mr. Ron Siegel does and send it out to other people. You can forward it. You can do whatever you want. Just don't say you wrote it. A couple people say they wrote it or at least insinuate it, but you don't have to give me credit, but I don't know. Actually, if you want to say you wrote it, go ahead. You got my permission. And you can sign up for our text alerts. Those are proving to be important in the current market. So don't forget to check those out at ratetextalerts.com. Let's go ahead and say hi to some of our live folks. Remember, if you're here this morning, say good morning. Let me know that you were here. If you're watching the replay, do me a favor. Give me hashtag replay in the comments. Don't forget to smash that like button. Let's go ahead and welcome the live folks. Rob Stewart, Mallory Fodiatis, Rob Wilson. Good morning, Angela Walters, Tim Kleila, Kathy Jensen, Tom Denmore, Brandy Brickler. Mr. Ron Siegel says today is National Nutty Fudge Day. I've got some nutty friends, but I don't know about nutty fudge. I'm not a big fudge person, but I would eat some fudge, especially nutty fudge. Do I have any big nutty fudge fans on? If you are, raise your hand, say hello. Call yourself out if you are a nutty fudge fan, and or if you like your fudge with no nuts. Kind of like Mounds and Almond Joy, right? Thank you, Mr. Ron Siegel, Vicky McSweeney. Good to have you here. All right, let's go ahead and get started. I think I have to speed up the morning. What do you guys think? I give you guys time to hop on here, but I think I got to speed up this part of the show. I think I take too long before I actually roll into the good stuff. Let me know in the comments if you guys think I take too long to roll into the good stuff. So let's go ahead and jump into the technicals and share my screen. Let's take a look at what we got going on this morning, and then we'll recap where we were yesterday. So currently, if we take a look here, we've got mortgage-backed securities are currently down 15 basis points on the day. That is not good, my friends, not good at all. If we take a quick recap of what happened yesterday, let me go ahead and zoom in. I'm sorry, I got to move my cup because Sophia's on my desk here, and I don't feel like having her knock my coffee into my lap. So here we go. Take a look at what we had happen yesterday. Yesterday was not a great day for rate sheets. Bonds were already down about 20 basis points when pricing came out right here between 10 and 11 a.m. That's generally when you see pricing come out. We ended the day even lower. We were down about 35 basis points on the day by the time things have come out. If we take a look, let's move this to the 5-day chart. Remember, everything in front of this dotted line right here, this is today. Right, so this is today we got right here, and then we've got Monday, we got Friday, we got Thursday, we got Wednesday, right? So let's just take a minute and sit right there, and I'll tell you how I became the prince of a town called Waynesville. So you could see we've really been losing ground. As this goes down, down is bad for rate sheets. Down makes us a frowny face and makes us want to cry. We don't want to see these bonds go down. However, Thursday we had kind of a lot of volatility. We really had a lot of downward movement. We had some recovery on Friday, and it was putting us in a position where we were like, hey, not so bad. Yesterday, though, you could see that we ended the day even lower than our worst level on Thursday. And today we are tanking hard. Now, we'll talk a little bit more about why we're tanking hard today. But rate sheets today are going to be worse. If we take a look at Mortgage News Daily, using this as a reference point here, you will see that we are definitely not where we want to be. Let me just slide this over here. There you go. Okay. So taking a look here, you can see that rate sheets are moving higher. 6.49 yesterday, even higher today, probably back up where we were here, 6.54, 6.56. That's going to put us much closer to the high level that we saw. Remember, it was March 27th. Let's slide this puppy over. We'll zoom in. Okay. Zoom in a little. We can even get a little bit more here. There you go. So March 27th, we had our high point of 6.64 on March 27th up here. And you can see we're not there yet, but you can see that rates are creeping higher. We're probably right about here right now, matching last week's worst level. Not where we want to be. Oh, you guys aren't seeing this that clear. Let me move this over a little bit. Hold on a minute. There you go. Looking here, this is our worst level, March 27th. Last week we were testing and we're pushing our way back up there now, getting into those worst levels. That's not where we want to be, my friend. That's partly due to yesterday's worsening that we saw here in the mortgage-backed securities. And it's also due here. Let's go ahead and give this a nice clean refresh, and we'll shrink this down a little bit. And let's give this, there we go, slide that over. So take a look here. You can see this red candlestick today. This was last Thursday's worst levels here, and we are pushing our way back down there and getting there now. That is at 98.19. Right now we are at 98.25. We're not too far off of those levels. 10-year Treasury yield 4.45. We broke above 4.43, which has been our previous line in the sand, 4.43. We don't love that. And Ron, last time you said that we were at a technical, the next level would have been 4.53. I don't know if that's changed much, but that was where Ron had pointed out to me last time that we would have been bouncing up to. So this is not good, my friends. We'll talk more about it in a minute. Reprice risk is moderate. Bonds could continue to drift through the day today. We're losing ground, and it's very possible that we will continue to lose ground as we go through this. You can see, again, everything that's going on here. We'll just put this on the one-day chart here. Everything that's going on here today, this is all ugly. It's not what we want to see. Now, 8:30 a.m. Eastern time, this is when the CPI inflation data came out. Now, you want to see a surprise. So how did that CPI inflation data come out? Inflation soared like a bird. It soared to 3.8% in April, driven by gasoline prices. What a surprise. Now, let's remember something. We can look at the core, which removes food and energy prices, but everything is going to start to be affected by these fuel prices. How long until we see what we saw back in, I think it was like 2015, 2016? Remember when everybody was adding fuel surcharges to their bill? Waste Management, the garbage company, the delivery companies, UPS, everybody was adding fuel surcharges because gas was so expensive. I think we're going to start seeing that again because everything going on in Iran continues to just drag on and on and on and on and on. It's just, this is all just dragging on. So let's go ahead and go through today's headlines and take a look at these together. So first one, key sticking points for U.S.-Iran peace deal. Now, remember, this is not political commentary. But this is what is driving mortgage rates. This is what's keeping rates in the mid sixes rather than in the high fives. Before this whole debacle, as I choose to believe it has been and as I call it, and again, that's my opinion, but before this whole situation, if you want to be a little less inflammatory, sorry, taking off my ice pack here. before the situation, we were in the high fives, and now we're not. So key sticking points: Iran and the U.S. have been locked in a stalemate since agreeing to a ceasefire in April. They've been unable to reach a deal to end the war that has stretched more than 2 months. Both sides continue to say that they have the upper hand and that they're winning. They're both lying. We're all hurting. Everybody is hurting. Tensions remain high as Iran maintains a tight grip on shipping through the Strait of Hormuz. And I think this has been the big surprise. I think the fact that this is I don't think that the Trump administration was expecting Iran to be able to shut down the Strait of Hormuz the way that they did. I think that has been the big thing that really has, kind of made this a whole mess on our side. I think we would have had a much more decisive military attack situation if they weren't able to then be, putting all this pressure on everything else with the Strait of Hormuz. Think about these ships that are out there too, by the way, rationing food. This is like, for us, I'm so blessed to be sitting here in my lovely barn talking to you guys and, having my cashews and coffee. There's these boats, they were not out there for this length of time. They were not looking for voyages. A lot of them have been rationing food. They're dealing with situations like that. These are things that have to be coming into play, but yet we don't ever really see anything talked about with them. I think there's 1,500 ships that are out there. Does anyone know a number out there? Let's see. Fuel surcharge is already being added. The post office even started that previously. Yeah, I didn't even see that. But yeah, I mean, so here's the thing: Strait of Hormuz. This is a big deal. So we opened up a can of worms with this one because it kind of let Iran know that how much control that they actually had, and now they want reparations. They want fees and payments, and there's all kinds of things going on here, and it's a big train wreck. So that's a big problem. The other thing, of course, being that Iran would say that they're not working on enriching uranium and looking for nuclear ambitions. Now, where does all this leave us with some other stuff? Let's hit the CPI data real quick, and then we'll come back to where bonds are at, and then we'll wrap it up for today. So inflation soaring 3.8% in April, driven by gasoline prices. Figures reported Tuesday by the Labor Department surpassed the previous month's reported increase of 3.3%, and it was higher than what was generally expected, but not that much higher. Prices rose 0.6% in April from the previous month, in line with economists' forecasts, and slowing from 0.9% in March. So that's partly why we're seeing a little bit of a better reaction. But again, we saw the strong positive reaction here. There was almost like a little bit of a relief. Actually, let me make this yellow. It's a little clearer. Okay. There was a little bit of relief right here when it came out and bonds kind of rallied. But since then, they've all just started to drop down. I mean, that's, traders are taking this position. I will look at the variance in pricing coupon. Ron pointed out that the 5.5 is only down 2 basis points. The 6.0 is up 7. Ron, let me go ahead and let's see. Interesting. The UMBS 5.0 is down 17. The 5 is down 3. Big variance today. You like to follow the coupon that is closest to par. I would still argue that the 5.0 is still closest to par at the moment due to trading volume, at least according to what Matt Graham is saying over here at MBS Live. And what I think, though, is you're seeing where markets are moving to. So this kind of coincides with this article about the bond market and the Warsh trade. So everyone said when Kevin Warsh comes in, that's going to put the Fed in a position that they could go ahead and cut rates. But if you look at Fed futures, there is absolutely no expectation of rate cuts anywhere in here. June, July, and then look, this is a hike. Notice the columns got shifted. This shifted left when we go from June to July. June, look at this. It's just been June now 100%. So this is all real time. So you're seeing, all right, there we go. July, 95%. Then we get to September, and it goes to 92%, but it goes rate hike. Okay, October, you've got 21% expectation of a rate hike. December, now look at this. This is a big, big difference. Remember, this used to be even. It used to be even. We used to be like 11% over here and 11% over here. And now markets are looking at rate hikes, dude. Rate hikes. This is due to the CPI data this morning, as well as, because if we compare that to yesterday, I don't think there was anywhere near. Look at that. Yeah. So yesterday it was 21%. Now it's up to 30% expectation of a rate hike by December. And as we move into next year, it continues to grow. Markets already understand there's no reason at all to expect the Fed to need to cut rates. Trump can jump up and down and cry, and he'll say that Kevin Warsh is a loser, but we've got high inflation, and even though, like Ron has pointed out, that there's definitely holes in the labor market data, it still points to a pretty strong labor market, a significantly resilient labor market that doesn't require rate cuts. So we're not in a position. But if you look at the 6.0 coupon, it's actually positive on the day. And if you look at the 5.0, it's down significantly on the day. What does that tell us? It tells us that traders are investing in higher coupons because that's where they think rates are going. And as we continue to see, that 5.5 is kind of in the middle, and the 5.0 is minus 15. So whichever way you want to cut it, rate sheets this morning are still going to be worse. -2 may not sound like much, but I bet your rate sheets, I think, according to the secondary people, I have a couple of relationships, Ron, and a couple of people that I've talked to, and they are still monitoring this one. And that's kind of where they're at. And we're looking at that 10-year treasury yield still kicking us in the butt. So, all right, y'all, let's get to the good part and wrap things up on the day here. So my rate outlook for 15 days, we're looking at locking. I mean, it's just the door is open for things to continue to get worse. We tried cautiously floating as things were improving a little bit, but I'm back to a locking stance because I think that we're going to see it get worse before it gets better from here. Anything 15 to 30 days, you can cautiously float, but you really need to assess risk. Here's the thing. When we talk about 15 to 30 days, we're looking at 3 and 4 weeks out from now. The main question that we have to ask here is, what is the likelihood that we're going to see the Strait of Hormuz open and some kind of a deal with Iran? It doesn't even have to be a great deal, and it doesn't have to have anything to do with nuclear. Now, Trump has said he will not do anything if it doesn't achieve all of his aims and goals on negotiation, especially and including the nuclear piece. But for markets want to see oil prices drop and the Strait of Hormuz open up again. So the question becomes, when you're cautiously floating, it's like, well, because, hey, I mean, this thing's got to get done sometime, right? So are we talking 2 or 3 weeks from now? But remember, it's already been a month of ceasefire, and we have made zero progress. Or maybe 10% progress, because at least now they admit that they're talking, right? So we're kind of looking at that. And then 30 plus days, we're cautiously floating. But even that, this conflict continues to drag on, but it has to end sometime, right? And that's what's going to help rates to drop back down. Oil prices will start to move when the rest of the world starts to get some relief. Don't be totally fooled. We have companies, these oil companies are making a lot of money in the U.S. markets right now. We do not need to have prices as high as we have them. But they can charge it because of the global situation. But the U.S. creates a lot of our own oil, and yet we don't seem to be benefiting as much as we could be. Everything is being priced on, it's priced as a global market, and that's why we are still paying the price here. So keep that in mind. But again, rate outlook for 15 days, I would lock, because I think things are going to continue to get worse this week and maybe even into next. There's nothing that really puts us in a position to see anything but the slightest of recovery from here. And if that's what we're fighting for, things could continue to get worse until we get there. We're already seeing things move up. Rate outlook for 15 to 30 days, cautiously float, but don't be afraid to lock in loans, because there is a good chance rates could be higher in 3 weeks. If we do not see some reprieve, the longer this whole situation drags out, the more immediate impact we'll see rates go higher. But longer term, it's going to hurt our economy, and we'll have a chance to see a recovery. So that'll be farther out. Ron says, we are not really using our oil. We export our oil and consume imported oil. Isn't that kind of a broken system, right, Ron? My prediction is the Strait will open without Iran passage following the China summit. China needs the oil too. You think without Iran passage, meaning you think the blockade will stay up? or that they won't pass the peace talks. You get the gas prices, but we didn't print 1 trillion in the last year. Money supply, you can predict inflation. That's true, but the inflation that we've had, Mike, has not been because of that, arguably, depending on who you talk to and the economists on that. So, but yes, we've definitely had that. ChatGPT is reporting the volume is trading the 5.5 today. I don't think ChatGPT actually has the proper connection to the sources that would give that. So I wouldn't believe that. I think ChatGPT will tell you different things, even though it's not necessarily relevant. The Iran deal is dead. Your opinions will start kinetic strike shortly after the U.S.-China summit. Yeah, I mean, that's the thing too, is where do bonds go if we do start strikes? If there is, escalated military action, do we see any kind of flight to safety? Probably not. We probably see increased oil prices, more fear, and see things continue to worsen. So that probably is going to be a tough one. So good morning, Amy and Zane. Don Albert, great to see you. So anyone else have any questions? Ron says, yeah, the blockade will remain on Iranian oil. The oil from other countries will commence. We'll see. We will see. We will see. I don't know necessarily where things are going to go, but I hope they go somewhere, because the way things are continuing now, it's really not helping us. Look at that cat. Here, let me turn off portrait mode. Sophia, what you doing, Sophia? Sophia. She's like, what? What you want? She's funny. So, yep, I love my cats, yo. Anyway, hope y'all have a fantastic day. We will see what tomorrow brings, and we'll talk about it. Hope you will join me. We will always be here 9:30 a.m. Eastern time talking about what we got going on. So, all right, I'll see y'all tomorrow. Take care. Make it a great one. Bye-bye.